Hello, everyone. This video is meant to be a supplement to our monthly Post MPT newsletter we send to our advisors. If you aren't familiar with these models or need a refresher, the iSectors Post MPT allocations are the flagship strategies here at iSectors. Post MPT Growth has a nearly 20-year return history since its inception in 2005, and Post MPT Moderate has a 16-year history dating back to 2008. These were some of the very first model portfolios available on the InvestNet platform back when it was first getting off the ground about 15 years ago. The Post MPT models are dynamic asset allocation strategies based on a quantitative algorithm powered by economic factor data and a more sophisticated definition of risk. These models trade monthly amongst 9 low correlated sectors in low cost ETFs and are available on about 10 different TAM platforms. All right, that's probably enough background on the models for now. If you'd like more information, just visit our website, read the detailed white paper there, and give us a call. So, in the newsletter this month, I wrote about how both Post MPT Growth and Post MPT Moderate hold overweights to defensive sectors versus their benchmarks: healthcare, utilities, bonds, gold, sectors and asset classes like that. You can view the full detailed holdings in the newsletter itself if you wish. During volatile market environments like what we're currently living through, when our models are allocated defensively like this, they're usually able to provide downside protection versus their benchmarks if the market takes a turn for the worst. At the same time, they won't give up everything on the upside either if growth stocks continue to run like they have for the last 2 years. Each model does also hold about a 30% technology allocation to go with those defensive sectors in case something like that happens. This chart highlights the downside protection point for post-MPT growth specifically over the last 20 years versus its benchmark, the S&P 500. This chart shows average 12-month rolling returns for each investment in 3 different market environments. The first box on the left shows how post-MPT growth and the S&P 500 perform in periods when the S&P has a negative 12-month rolling return. On average, stocks are down nearly 15% in these periods, while post-MPT is down less than 8%. It outperforms in almost 80% of those periods, with only about half the S&P's loss. The middle box shows a more choppy environment, when the S&P is up in a 12-month rolling period, but less than 10%. This is where our models really have the potential to shine. Post-MPT growth outperforms the S&P about 60% of the time in these periods, while capturing about 160% of the market's gain. In the last box on the right, you can see that post-MPT growth is still able to capture nearly 60% of the S&P's gain when the market goes up more than 10% in a 12-month span, which we believe is a fair trade-off given how well the model performs on a relative basis when the market is up less than 10% or down in any given 12-month period. We like showing this chart because it reinforces our confidence in the defensive positioning our models currently employ and the potential downside protection that they can provide. Thanks for watching, everyone.